Not all entrepreneurs are great investors, and not all great investors are entrepreneurs.
If you have an equation where you genuinely want to make a difference to their lives, that's the kind of person you want. Because the guy you feel, arey yaar, you don't want to make a difference to his life.
So when do I decide that I need more information via a wealth manager?
BlackBerry example, you have Nokia example, where there are phenomenal stocks, large market valuation. In India also you have had companies, a lot of the PSUs historically, which have gone to almost zero.
I bought a large chunk of ICICI securities at one point. So I was like, ye badhega, badhega, badhega. After that, I have never sold a stock. Hello everyone. Welcome to Life Unscripted once again. I am Sharad Goyal, and today I have a guest with me with a very diverse experience set. So please help me welcome George, who is the director at Anand Rathi Wealth Ltd. He has over 17 years of experience, manages over 1,000 crores of assets, and deals with hundreds of clients on a daily basis. Throughout his career, I think he must have worked with thousands of clients, had hundreds and thousands of questions, and has moved one step at a time to reach where he is today. So, welcome, George.
Thanks, Sharad.
Welcome to Life Unscripted. I am so happy to have you here.
My pleasure.
Just to begin with, George, I would like to know, and I think our viewers would like to know, how did you start your career? I mean, wealth management is a very upbeat and a different kind of field 17 years back.
Absolutely.
Right now, post-COVID, everybody wants to be in this segment. But what got you interested in this?
So Sharad, I think like you said, it has been a journey which has had its own ups and downs, and I think sometimes it's also a roll of dice. You get lucky with certain things. You get lucky with mentors who give you the right direction. So I actually started off my career in something called as equity research or corporate finance. It was immediately out of college. So I finished my MBA. I got placed out of college, and corporate finance, equity research was the field I started in. Somewhere along the way, I think I realized that I loved helping people, assisting people to get their finances in order. And that role was better fulfilled on the front end rather than the back end. So equity research more is a back end kind of a role, and wealth management is more of a front end kind of a role. So that's where the initial push to get into the front end happened. Honestly speaking, I think Anand Rathi is where I started off in the front end. Before that, I was always a products guy. So it was equity research, it was PMS, it was structured products. Those were the kind of instruments I got to kind of work on. The advantage there is you get to learn the brick and mortar. So if you want to build a house or a person's financial portfolio, it's always good to understand the basics. So when you start from the basics, you realize ईंट कहाँ लगना है, cement कहाँ लगना है, that kind of thing, and what works and what doesn't work, right? So obviously had a reasonably good exposure across product categories. There are only 4 broad asset classes you can invest in. It's either equity, it's debt, real estate, or gold. So these are the 4 broad asset classes you can invest in. Now the only question is how much of each of these you want, which defines how much risk you're taking and what is the expected returns you're making. So the grounding helped me, the equity research background helped me. Once I came on the front end, I think I was able to evaluate, meet people, understand what they really needed, not what they were asking for, and giving them that solution or option to get to where they needed to get to. So that's, I think, where the transition happened to wealth management.
So would you call like there was a pivotal moment, like when you realize कि यार this is the moment, like I need to take this switch. Like always people want to start a company or maybe get out of a job, but वो सही time कभी आता नहीं है. So was there like a particular moment for you which made you switch?
So actually, yes, Sharad, because so there are 2 parts to that also, and there is one which was a personal career reason, and one was what I was doing when I was interacting with people, right? So the personal career moment was, like I said, I was an equity research analyst. I came out with some great reports. I met company promoters. I drafted the reports, and when you make these reports, you have a target price. Today the price is 50 rupees, it will become 100 rupees. And a lot of these reports actually delivered the number that I was talking about. They hit the target. And it was, as usual for anybody who has a job, time to meet your CEO for your annual increment. And I told my boss that, boss, targets have been achieved. All the numbers that you wanted me to put down have been put down. So he said, yeah, but the company made so much from all the targets that you achieved. So I said, sir, but that is not my fault. It is the person who was in sales. He didn't take it to enough people who were convinced on it. He said, but George, that's your fault, right? Because you're the idiot who's brilliant at the desk, but is unable to go and take it to the people who matter. And you are dependent on that person. So who's a bigger idiot? Right?
So basically, it is always about that one person जो आईना दिखाता है, like this is what you are going wrong about.
So I realized that, okay, so number one is I need to be in the front desk. If I'm convinced about something, if I'm passionate about something, and if I can't communicate that, then I'm not completed my job. Just identifying does not get the job done. It's also about communicating what you strongly believe with conviction, right? So that was one part of it. The second part, which is also interesting, is and not meaning any disrespect to anyone. While I was in this role and as a product matter expert role, I used to take products with a possible relationship manager to his client. And I very often saw very high degree of mis-selling because there were products which had a lot of value, right? But it was valuable if you had it as 5% of your portfolio. If you had it as 30% of your portfolio, the portfolio will be in trouble at some point of time. But I was told that that's not your job. That is my job. You just come and explain the product. If you did a great job of explaining a product very well, in the sense marketed the product very well, then instead of doing 5%, which is what is recommended, you end up doing 30%. So I said that, honestly, he's right. It is his client. He can do what he wants with it. So if I'm not comfortable with it, the option is find your client. Right? So that was my second reason. I really felt that I could make a big difference. And I felt that doing things in a certain way, which I felt is the right way, I'm not saying that's the only right way, will make a difference to the people I'm engaged with. And fortunately, in the last 11 years that I've been with Anand Rathi, I've almost lost no clients. So every client who started 11 years ago.
Yeah, that's an achievement in itself.
Absolutely.
Like,
so,
I think retention,
yeah. That's a real achievement that I'm proud of. Everything else, the numbers, all of those things don't really matter to me. The fact that every guy who started with me 10, 11 years ago is still a client and has grown with me is something that I take a lot of pride.
So this is one of the things that I do at Entera as well. So like, since we just came out with our CRM product and when we were looking at people, so whenever we got somebody and my team used to ask, sir, fatafata, why are we not getting more people in? So I always tell them, it is not about getting more people for me, it is about retaining. So let's get one, then let's get two, and make sure that they have great value experience. They get great value out of whatever we are giving them, and they stay with us. So trial se wo paid mein convert ho, and then slowly we'll get more. But if I keep on getting more and you're unable to serve them, we are gone. And being in your field that is managing such huge amounts and retaining the clients without redemptions, it's a huge task.
I think, Sharad, you hit the nail on the head again, so and I was put this very nicely by one of my mentors that I'd asked him once that how many clients should you have, right? And that's a tough question which all of us go through, that what is it that you can be fair to, and how can you service the X number of people, right? So you don't want to have more clients than that. And I was lucky to be in that position that I had, in a way, saturated my book. And he said, see, George, the number of clients you should have is when you can answer anybody's call, even at 2:30 at night, with a smile.
Yeah.
Right? Then he should be a client.
But see, I mean, even if you have, let's say, 10 clients, there's always going to be that one fellow whose phone rings and you're like, Arey yaar.
No, but so that's what I'm saying. That's a choice, right? So if you feel arey yaar, then you know that is not the client you need to have.
Okay. So have you ever had such a client which you had to basically fire or let go of?
So I have had, in this 11 years in Anand Rathi, one client that I've given up on. right?
I think that's huge. Like in 11 years, one client. I mean, it's not even one client a year.
And this is exactly what you said. I used to see the phone. I'm like, yeah, I have to answer him. He'll ask me questions which are not related to what he is, involved in or dealing with. So it's just that you have to at some point of time. And I agree, when we start off our careers or start off our businesses, or I think you will take anything and everything on board. Okay? But it's means for yourself and for that person. If you have an equation where you genuinely want to make a difference to their lives, that's the kind of person you want. Because the guy you feel, "Arey yaar," you don't want to make a difference to his life. Let's be very, very honest with ourselves, right? So, it, like it or not, it will trickle down in the way you do things.
Definitely. And so, as you talked about communication, and you switched your role so as to communicate what you feel is right, have less number of clients, focus on retention of the clients. Uh, don't you think that in the field of finance and wealth management, there's always gonna be ups and downs, which is always there in the market? So, what are the challenges you faced in your journey when delivering the bad news that the funds are not doing as great as we basically thought it would? Because I mean, I have tried it. Nobody can time the market. I mean, I still try it. I'm not going to stop at it. But how do you communicate that?
So like you said, right, when you communicate, you set expectations. And when things are going well, and last 1 year things have been phenomenal, right? So everybody thinks last 1 year's returns is the norm. But if you consistently reiterate the fact that this is an anomaly, you enjoy the anomaly, but don't start trying to pick anomalies. What I mean by that is, you buy a lottery ticket, you win a lottery ticket, go party, enjoy yourself, totally, go berserk with the celebration. But don't start believing that you know how to pick lottery tickets, because that is when you get into trouble, right? So I think it's the same with money, right? It's always about expectation setting. It is always about what is the fair return, and then there will be returns which are on both sides of the fair return. So let's say 14-15 is a fair return. You will get 7-8% sometimes. You might even have negative 5-10%. But that's what comes along the way, and you don't have to really worry about that. It is about communication. So I think, again, I'd read an article, I believe, which talked clearly about why wealth managers lose clients. You talked about the fact that I've not lost clients in the last 10-11 years, and I had mentioned that as well. So the reason people tend to leave an advisor more often than not is because of lack of communication. So even at the, let's take a recent fall like COVID, right? At the peak of the fall, I think the biggest mistake that some of us wealth managers made is we refused to pick the client's call. He knew the markets had fallen. He needed somebody to talk to tell him that it's okay, stay invested, and you'll come out of it.
So I would like to add something on it in form of a question only. How does a person know that he needs a wealth manager? So like, let's say that I'm a person, I'm investing myself, I have some knowledge of the internet and the great apps that's there in the world, and I have some understanding of the stock market. So when do I decide that I need more information via a wealth manager? I mean, what is that point?
So, you can call the wealth manager, and literally all of us know to drive, right? But some of us still have a driver because we feel there's a value add there, right? All of us don't have a family doctor, but most of us tend to want one guy as a family doctor who we can call up in case of any medical issues, right? I think a wealth manager is somewhere in between these two people. You can do everything that a wealth manager does if you can put the time in place. And if you want to know if you need a wealth manager or not, the answer is very simple. If I ask you, Sharad, that what was your first job that you took and what was your first salary that you took, you will know that off your fingertips. You probably might know how your turnover of the business has grown over the last 5 years off your fingertips. What was the PAT also, you'll know off your fingertips. But if I ask the same Sharad, what was his balance sheet 5 years ago? And when I mean balance sheet, the entire 100 rupees that you've put aside as investments. And what is the rate of return on that net of taxes that he has had over the last 5 years? Most people will draw a blank.
Yeah.
Right? So if you're drawing a blank, then you know you need an advisor.
Okay.
Okay. Now, what is a good advisor? What is a bad advisor? That's separate. I'm just saying this is means that you need somebody who will do the maths and bring it to you.
I think it is also about when you feel saturated. So, like for me, I think the need of wealth managers came into place when I felt that I'm saturated and I need that extra jolt of knowledge. So, like when, as you said, that taxation was the key driver for me. So, because like you're doing something, you're taxed, and sooner or later you feel like after doing it for 2 or 3 years, you feel like yeah, kuch bacha hi nahi. So then you need somebody. Am I missing something? Is there something which is gone?
So I think again, I think you hitting most of the nails exactly on the head here, because taxation is a free lunch, right? Literally, for every other percentage of return you're making, you're taking risk. So you're increasing your risk. That's why you're increasing your return. Tax, however, is a free lunch. That is one part. Think of the other aspect, right? Let's say I say that, Sharad, this is 1,000 crores. Let's buy an IPL team, right?
I don't think we would be able to buy though.
So Sharad will say that 5,000 crore का नुकसान नहीं करना है, George. So let us take the top cricketers who are playing, who have track records, and who can deliver what we want in this team of ours. Then we have a probability of winning, a higher probability of winning. That's the same thing, no? When I am doing something for a living 24/7, and in the middle of that I'm trying to do something else as well, I will not know all the tax laws that are available for me. I will not know all the anomalies that exist in investments. I will not know how to decipher the marketing information that somebody is bringing to me and saying that, okay, this is actually relevant, this is the numbers. You need somebody to just do the numbers and bring it to you on a single sheet of page. Simple. A single sheet of paper, you get that information, you know what is to be done. Most people don't have that information. So we are taking assumptions to take their decisions. And then there's
So basically, we are managing our expectations based on our assumptions, not on the facts.
facts. You need to know
So
numbers.
I think I have another thing which I came across. It's basically, so I heard this, a very well-known fund manager. He mentioned that not all entrepreneurs are great investors, and not all great investors are entrepreneurs. So basically, as you said, that once you have that 5,000 crore ka corpus, I mean, you need to look at the facts and create a team out of it with coaches and great people. So how much do you agree with this statement?
So Sharad, just think about it, right? We know so many top creative individuals. We know how many top sportsmen who died poor. So that itself says it, right? Personal finance, unfortunately, is not an optional subject in life, right? You can take anything else. मतलब मेरे को हिंदी नहीं करनी है, ठीक है, फ्रेंच नहीं करनी है, ठीक है, मराठी नहीं करनी है, जो करना है करना नहीं करना है वो डिसाइड कर लो. You can still become a great entrepreneur.
But the fact is, personal finance is not even a subject at the moment.
That's a separate discussion altogether.
Yeah.
Because absolutely right, you need to have that as a subject. Because it's so funny. We work 365 days, 24/7 to make some money. And then put some money aside for a rainy day or old age, whatever. But we are so focused on what we are doing 365 days and 24/7. But we have no clue that ye karne ke wajah se the money that we have taken out and we have parked it aside, how much that is doing. So very often I see situations where a person has worked for 25 years. He has saved also some money. But that money is compounding at 4%. So, sir, if your money is compounding at 4% and inflation is aggressively 12%, conservatively 7%, you're losing the value of money. So you're going to die later anyway. At least blow up the money, enjoy yourself today, and keep that, So that thought process, unfortunately, and very often, when do even most salaried individuals, when do they think about where their money is saved? When you're 56 and you realize you're 58 पे रिटायर हो जाऊंगा, तो अभी महीने का जो 3 लाख रुपए या 5 लाख रुपए या 10 लाख रुपए का खर्चा है, where will that come from? So let me see where I've put my money. And I've seen such funny situations where a large part of that money is in real estate, which is not a bad investment, but it's an illiquid investment. If I need 5 lakhs a month for my household expenses, you cannot take it out only from real estate. You need to have other instruments which are liquid enough, which you can pull it out of. So I think that is where this dichotomy kind of exists.
So building on to that, like considering that I played it nicely, I tried to navigate between investments and entrepreneurship and business and the life in general. So I had the rainy day money aside, and I had great advisors. So that money is also very planned, and I'm beating the inflation or matching the inflation at all times. When do you think I should think about selling? Because with me, what has happened is, so I bought a large chunk of ICICI securities at one point. So I was like, ये बढ़ेगा बढ़ेगा बढ़ेगा, and I started losing. So I lost about 5 lakhs or something in that. That was like one hit moment for me कि आज के बाद तो बेचना ही नहीं है. After that, I have never sold a stock. Then I still wonder that what is the right time to sell. I mean, of course you can hold it for life, but companies go up and down. So how much should I watch? How should I watch? Again, how should I balance that entrepreneurship and investing? And when do you think about selling?
Okay, so just like I said earlier, that I have cash flow requirements. Today, I have cash inflow consistently. So I'm building a portfolio. And if I take any timeline in the last 15, 16 years, and most mutual funds or most structured instruments which we talk about, they have all consistently grown. COVID, they've fallen, then they've grown again. So all of them are at a much higher space or place as far as NAVs are concerned or returns are concerned than it was 1 year back or 5 years back or 10 years back. So the logic to sell those don't exist. That is as far as a mutual fund, for lack of any better instrument. Now, when it comes to stock, it becomes a little bit more complicated because you need to understand the business, right? We have BlackBerry example, you have Nokia example, where they were phenomenal stocks, large market valuations. In India also, you have had companies, a lot of the PSUs historically, which have gone to almost zero. So there it's important to understand the business and keep an eye on it. So if you're a buy, fill it, shut it, forget it kind of a guy, then maybe stocks are not the right options for you. If you still want to do that, and typically what I do for myself is, I will pick up stocks where I have a reasonably high information flow about one, the business, and about the broad environment in which it functions. Because Kodak, right, is extinct. So a lot of individual companies can become extinct. If you're a person who does not track the markets, then probably you're better off just buying an ETF or an equity mutual fund and sitting tight. Right? The timing thing, enough people have said that they can't, but I would say even I don't understand. And look at it, the world's among the world's most prominent investors is Warren Buffett. One of the most prominent investors in the world is Warren Buffett. His holding company is Berkshire Hathaway, which was a textile company, which as an industry failed in the US. Then he converted into a holding company to hold Coca-Cola and Gillette and everything else. And that worked phenomenally for him, right? So even somebody who is the best investor, or at least known to be among the best investors in the world, right? Even he can buy something, one of the first buys, with high degree of conviction and be worth, the underlying business is worth nothing. And look at Indian companies, right? They say sleeve to sleeve in 3 generations, right? So if you see most of the top 10 market cap companies in India, over the last 3 decades, they have completely changed. So HDFC Bank, which is one of the largest market cap companies today, did not exist before 1990 in a serious way. And today has had 3 years of zero return when the markets have doubled, right? So it's not that HDFC Bank is probably not a great company anymore, right? But 3 साल का return zero है, negative 3-4% है. So if you are a direct equity investor, you need to have patience and you need to know what's happening in the company. More than the profitability has doubled in 3 years again, right? So there is no underlying reason that this should happen, but you should be patient enough to sit back and.
So is it safe to say that as an investor, the best time to come out is when you need the money?
Absolutely.
If you don't and you have done your due diligence, the company is healthy and all, stay the course, let it flow out, and wait as much as you can. But if you need the money, all hands.
So any good investment, like they say, is perpetual.
Okay.
When you need something, right? And I think this is again where I would like to touch upon the fact that, let's say I have 100 rupees, right? And you have a lot of these products that come your way. This is like a child plan, a pension plan, a retirement plan. So my 100 rupees is 100 rupees, irrespective of what is the end use of it and when I need it. So why should I call it an X plan to make it better? So my 100 rupees should be managed the most efficient way possible for 100 rupees. based on the timelines of it, right? Any timeline beyond 7 years has to be broadly in equity. Anything less than 3 years has to be broadly in debt. Now, in debt, what you want to pick and choose and how you can increase tax efficiency is the only discussion to be had, right? But to have an instrument which is called a child plan or called a pension plan is silly. Because do you mean to say that money that I need post retirement to buy a car can grow at 8%, but money that I need for living has to grow at 14%?
This just reminds me, I had this salesperson at my office, and he was trying to pitch me something for my daughter. And he was like कि sir, this is like very risky, इसमें ना minimum 5 years का lock in है. So I said, first of all, 5 years lock in. Okay, that was like a shock. And he's like, but अगर चला तो it will give you this return and this return, it's very good and all that. So my only question was, dude, if it is a 5-year lock in, I mean, first of all, what is the point of it? And you want me to have a horizon of 10 years? Why should I not just take like a stable mutual fund, maybe a little bit of blue chip, little bit of small cap, little bit of mid cap, and just leave it for 10 years? जब चाहिए मैं निकाल सकता हूँ, 1 साल के बाद, मतलब लॉक इन तो है ही नहीं. There's only that exit load for 1 year, and I'm completely flexible. मैं यहाँ तुझे दूँ, तुझे पता ही नहीं क्या होगा. It will still take 5 years, and it is completely locked.
Exactly, and this is exactly what I very often come across, right? So we hear about NFOs, right? And like you just said, right, you have lock-ins. Now, one, I can show you data which clearly states that the lock-in funds tend to be, more generally speaking, bigger underperformers than open-ended funds. So that data is one aspect that we can probably touch upon. But more importantly, if I can buy an instrument which has a 5, 10, even 15-year track record, then why should I go and buy something brand new with zero track record and an assumption that it might make money? So basically, my money and me is the guinea pig, right? Literally test case. If it worked out, great.
If it didn't,
okay, you find an wealth advisor will find another.
Yeah, we gave you that disclaimer to thai.
Absolutely.
Yeah.
So that's exactly what you were talking about, and this is a problem. So this is a problem that is there in general. But I think broadly things are getting better. People are becoming more mature about it. People are looking at where the monies are and wealth management or finance, their own personal finances, in a more structured way now than they were ever before. So that is happening. That's the good thing. So let's see where that goes.
Great. So George, moving onwards, I think everybody talks about the long-term horizons and long-term investments. I think we have also been talking about it for the past few minutes. How about short-term? So like businesses in today's day and age, we get our checks and then we have nothing going on for the next few days. I think startups, SaaS companies like mine, we have occasional inputs of money coming through.
Right.
So what do you think would be a very good strategy for us? Because there is only so much you can do for the bottom line. If you want to increase your cash flow, I mean, to generate that extra profit, it's a lot of work. So this is what I tend to do in my family business. So let's say if I get the funds on a Thursday, I just check whether Friday ko kuch karna hai ki nahi. If there's no payments in mind, then I just dump it into one of the debt funds. This is like a no-brainer, no questions asked thing which I do. And then we decide Monday ko kitna nikalna hai and we take it from there. Now, if you calculate 3 days in a week, that's like 52 weeks in a year. So that becomes about 150, 160 days. Now you factor in the festive seasons, like we are a festive country.
Absolutely.
So you have the Diwali mein 5 days extra, you have the Holi mein 5 days extra, then you have the smaller festivals, Navratri, Dashera and all that. So I calculated it once, it goes up to 200 to 220 days, which is more than half a year. So imagine if you could roll a certain chunk, call it 10 lakhs, call it 1 crore, 10 crore, if on a constant basis, so you are making at least 6 to 7 months ka returns for no work at all.
Absolutely. So Sharad, like you said, in business, an entrepreneur is so much effort, right? But if he does just this, which is just a click of a button, practically speaking, you can probably recover the cost of definitely an accountant, but even maybe 4 or 5 people around him, right? And it's as simple as click of a button, keeping track that every Friday it goes in, every Monday it goes out. So no brainer. That's something that all entrepreneurs, all old school businesses, all should look at. Definitely.
So now let's talk a bit about risks. Like whenever entrepreneurs think that we will put some money in and if we lose, how would we manage our expenses? But at the same time, they are leaving those small profits. So in the various asset classes, which do you think is the most safe asset class for an entrepreneur to do the short-term jugglings?
So for short-term jugglings, honestly, there is no option. There is only one solution for this, that is debt. Now, debt itself has multiple instruments that you can look at, right? You can look at 1 day, 2 day parking. You can look at overnight funds, which have close to no risk, not close to no risk, they have absolutely no risk. Then you have liquid money, which is, I would say, a fortnight plus, so 15 days, 45 days, that kind of range. Then you have things like ultra short term or longer tenure paper. And again, longer tenure, when I'm saying is relative, it's 45 days to 6 months on the higher side. You can also play around with the tax aspect because you have debt which is taxed at 35%, and you can do something like an equity arbitrage. So you can also juggle around with taxation, which is something that all entrepreneurs should look at, right? Because debt in the purest form is taxed at 25% in case of companies today. But equity arbitrage, which is called equity as an asset class, is taxed at 15% short term and 10% long term. Now that itself is a huge saving. So these are things that any entrepreneur should know about, and obviously the accounts team or the treasury team should track very, very closely.
Now, considering that an entrepreneur wants to be a bit more fancy and he wants to also invest into some stocks or equity related funds, what do you think would be an effective strategy for him to mitigate risks?
See, one way is again getting into slightly hybrid funds where you have a high degree of hedge on the underlying equity position. But hand on heart, if you ask me, no entrepreneur for the company's working capital kind of funds should look at equity. Equity is something you do either with long-term investment surplus or on his personal balance sheet, right? The company balance sheet, you're taking risk on business. You don't need to make an additional 2%, 3% on the money that is meant for business. Because tomorrow you have a situation where the markets are down 20%, you still have to make the payments that you have to make.
Yeah.
Right? So I think it's very important that timelines are clearly defined when it comes to company money.
So let's play around with this. Let's consider that we have 1 crore ka corpus in a SME, and there is a 1 year ka horizon in which out of this 1 crore, he might need some money at the end of 3 months, at the end of 6 months, at the end of 9 months, like per quarter,
Absolutely.
and then at the end of the year. How would you strategize and define the asset classes and invest into what kind of
So I would
instruments?
say 3-month money should be parked in between liquid and ultra short on the higher side, not beyond that. Maybe liquid 3 months, 6 months ultra short, and beyond 6 months in equity arbitrage. So that money can stay in equity arbitrage. So 12-month money is completed. And I think on weighted average basis, your liquid and ultra short should deliver around 6 plus.
6 plus at the moment, yeah.
And arbitrage should deliver about 7.5. Right? Liquid funds will be taxed at 25% broadly, and equity arbitrage will be taxed at, if you complete 1 year, then 10%, but otherwise 15%.
Now let's mix it up again. How about we don't know when we want to get the money out?
So if you typically don't know, what you can do is you can run a liquidity cycle. What you do is you start off with certain amounts, 20% of the money in equity arbitrage. When it completes your lock-in period, typically of 30 days, 45 days, 15 days, you move another 20% into that. And you can continue doing that till you start withdrawing. So when withdrawals happen, it will first happen from the liquid and not from the equity arbitrage. But in the 45 period, the equity arbitrages have also completed the withdrawal period or lock-in period. So there's no lock-in, obviously. There's only an exit load period, but there's completed your exit load period as well.
So basically, to sum it up, I think people should first understand how long you want to put your money in for.
Absolutely.
If you have no idea, then you want to play with it a bit, like invest smaller chunks into a bit more risky funds like arbitrage, or where you have like 15, 20 days, 45 days ka limit. and then you keep on adding so that you have the flexibility of withdrawals as per your need.
Absolutely.
And at the same time, you have very low risk of penalties, or what we call exit loads.
Absolutely.
So that's, I think, a very great insight which everybody in today's day and age can use. Now, moving on to a bit more trickier part, in which there are many investment options which are, I won't say hidden, but which are not very prominent, but they are very good things to do. So can you share a few investment opportunities which can yield you significant returns, but they are not marketed or they are not hyped as much?
So I think, again, going down in each asset class, there are typically great investment opportunities. You have equities. Equities, if you don't understand anything, you can just probably buy an index fund. But even if you go with some of the flagship equity mutual fund houses and the flagship schemes in those houses, then you are good to go. You'll get an alpha over the index, historically between 2.5%, which you'll manage, which is big returns over periods of time. So I would say equity mutual funds is among the best instruments you can use. The other asset class we can think of is debt. Debt again is defined on time, but if you have reasonably large timelines, you can look at anywhere between gilt funds if you have very long timelines, and if you have short timelines, then you can look at more AAA rated paper, things like that, where you get capital gain and you have a set off option available as time goes by. Let's go to gold, which is another asset class a lot of people talk about. The most efficient instrument today available for gold is a sovereign gold bond. Nobody probably sells it simply because commissions are not available on it today. But you're making whatever capital appreciation happens on gold tax free. So it's zero tax on the gains. It's unfortunately locked in for 7 years, 8 years. And you're making 2.5% interest per annum. So over 7 years, that also adds up to about 16-17% in absolute terms, which again, all add up, like I said. So these are the three broad asset classes that you can actively look at. Then you have real estate, which tends to be more specific. So then I won't get into that, because today India does not have too many options in real estate where you can comfortably invest. There are REITs that have come about, but they are, I wouldn't say, matured enough to get general money today.
So I recently came across, when talking about real estate, so I was talking to a person and he told me that, why you're scared of stocks? I said, no. So he's like, in real estate, you basically don't have a real time value of what you hold on a daily basis. But when you talk about stocks, every day the market opens, you get a message saying that this is your target price. And then you go online and you check कि मेरा आज का rate क्या है. And if it is down, you panic. If it is going up, you get happy. This happens day in, day out, and you never think about the same way in your real estate investments.
So Sharad, I think again, just look at it, right? Real estate historically in India has been, and not only India, even globally, has been one of those growth assets. So if you want to define asset classes, right, you have equity and real estate, which are growth assets, which can historically give you double-digit returns. And then you have debt and gold, which are supposed to adjust for inflation, right? But the difference between these four asset classes are timelines. If you're investing in real estate, the timeline you should be okay with is 20 plus years.
Exactly.
If you're investing in equity, the timeline you should be okay with is 5 to 7 years plus. If you're investing in debt, it should not be more than 3 to 4 years. Debt is money that is less than 3 years. You need the money. That is where you put money in debt. And gold, again, at times has actually beaten real estate, underperformed equity maybe. But there are 14 years, 15-year periods when gold will give you zero return.
And then it'll shoot up.
So nobody knows the year when it will shoot up. Right? But, I was doing some maths. I think in 1980, gold had hit $9,500 an ounce. If you're talking in dollar terms, because gold is defined in dollar terms. Right? Or is valued in dollar terms. And today, gold is around $2,200, $2,400 an ounce. So if you really look at it, at 15%, money doubles every 5 years. So in 44 years, it has just gone to 950 to 2,000. Right? What it should be is probably $9,000 an ounce. But in dollar terms, gold has not given you great returns. In Indian terms, we have seen gold giving you phenomenal returns. More so because the rupee has also depreciated.
Yeah, exactly.
So that is never countered or never factored into what gold returns have been there.
So when we talk about this hyping of something, like right now it's about the gold rush, ki gold is moving to kya kare and all that. So can you define one particular segment in which you feel is overhyped, wherein people are just running behind it, but at the same time there is very high risk and which is not advisable as a wealth manager?
So I think, timelines will again tell you if you are right or wrong on this, right? And gold is sitting on 5-7 years of consolidation. So there is a hype associated with it. I do see a lot of people running into it, probably not using the right vehicle. So sovereign gold bonds are not being actively used. People are using physical gold. They're not looking at conversion cost. They're not looking at the fact that you're buying 22 carat, not 24 carat. So, all of those factors are not being made. People will send you data which says, okay, gold was at X and now gold is at Y, so that is 12% CAGR. But if you take 20-year periods and 18-year periods, then that numbers are not as exciting. So I am a little concerned about the money that is rushing into gold. Also understand it's a non-productive asset class, right? Whereas in equity, you are seeing productivity. The money is being put to good use on an active basis. Gold is not the same.
Got it.
It does not double, it does not multiply. You're only dependent on, I think sometime back we could have said Bitcoin is one clear asset class where that concern is there, right? But crypto is a new asset class that has been coming up, and maybe we are wrong. 20 years down, we'll know if we were wrong not to invest in that, and maybe that's the best investment, right?
So on the same lines as we talked about the risky or the overhyped asset class, let's also talk about the stress that comes with investments. So as you have been a wealth manager for about 16, 17 years now, you must have seen a lot of ups and downs. And people can get really cranky when they lose money, right?
Absolutely.
So I believe that would have been a very stressful period for you whenever that happens. I mean, so what do you think? As an investment manager or as a wealth manager, what do you think are the strategies for a retail investor or for a normal entrepreneur who's investing to keep in mind so as to keep himself calm? Because every day, as I said, it's the clock is ticking, the sensex is moving, and you're looking at your finances, and then you get scared कि इसमें क्या हो रहा है? So is there any kind of trick which you portray for yourself?
So the trick is very simple. I think before you get in, right, you need to ask all the right questions. And you should be very clear about your timelines and the risk appetite, right? Because if your expectations are set clearly, then you're better equipped to handle volatility. Number two, and it's easier said than done, you cannot panic when an event is happening. If you don't understand, don't do anything. That is the rule. When you outthink yourself is when you get into maximum trouble.
Do you think we should also add, don't look at Google too much?
So absolutely no. When it comes to either your own medical health or your portfolio's medical health.
Yeah, we become doctors better than doctors by
Absolutely.
using Google.
So I think all of those things should be avoided.
Yeah.
And there is no question about the fact that, see, everybody will get stressed when you see yourself losing money. Everybody gets happy when you see yourself making money. That is natural. But expectation setting, I think, can help you to a great extent manage the stress that comes with it. And as an advisor or a wealth advisor, I think our roles, it's important that when those corrections happen, the communication lines are kept open.
Okay.
I think lack of communication when those stresses hit the roof is why a lot of investors make rash or brash decisions, right? So making sure that communication lines are kept open when the stress is high is as important as making sure you hold your nerves.
Okay. So now coming to my last question. You have invested in so many companies, you analyze the companies, you see their ups and downs, you look at the hierarchical chart, who's running what, like we do with the investment managers, who's the manager for which funds. Do you think there are certain practices that make a company really stand out? Because see, there are a lot of people here, startups bol lo, SMEs bol lo, seasoned companies bol lo. Have you seen like a trend? If there are certain features or certain characteristics that the company implements, they usually end up as a good opportunity for investments.
Absolutely. So I think there are two distinctive features which I like to, kind of notice in companies. One is the company being able to get into a habit when it comes to consumption for clients. So their clients are getting habituated to the company.
So like retention of the clients.
Retention, repeat usage. You know, let's be clear. 10 years back, we all thought, yeah, I will never buy something without touching and feeling.
Yeah.
Today, all of us buy on Amazon.
Especially the clothes.
Right?
Fit kaise hoga?
Correct. So today that has changed. Other example, more recently, and a listed company in India is, and I don't know if it's the valuations are justified or not, but you have something like a Zomato, right? You just stand outside your building gate, and in Bombay, and you will see 50 delivery guys coming, right? So you are so habituated to ordering from a restaurant, even one dish or two dishes, which you never used to do. So obviously these businesses, and as your countries per capita consumption or earnings goes from $2,000 odd per person to, or per family, to 6,000, that consumption is huge in our country, right? We have 1.4 billion people who are coming about. So those are one thing that I look at actively when I look at companies. I think the second thing is scalability. Is it a one-man show, or is it something that can be literally scaled to any number? It is not dependent on one individual whose idea was conceived, right? Because I could be very passionate about this, but if 15 people are not passionate, I will not be able to grow this business. But anything that is automated, anything that can be scaled up, will always have an edge over something that cannot be. So these are two things. I think scalability, multiplier effect, one, and two,
Consumption.
like I said, consumption, habituation, getting habituated to something. Right?
Getting addicted would be a better word here, yeah.
Absolutely.
So it just struck me. There's one more question which I wanted to ask. We have talked a lot about finances, personal and work. Do you think there's a difference between managing individual finances versus managing a company's finances?
Oh, completely different. So an individual generally has certain cash flow requirements. One will come if he's a family or something. There will be children, education, wedding, things like that, and then his personal life or retirement life where he needs regular cash outflow vis-a-vis inflow. So that is what an individual's balance sheet or financial portfolio is going to be built on. A company's balance sheet is more about efficient working capital deployment. There is short-term liquidity available when business opportunity is not there for whatever reason. And you're just increasing the efficiency on that. You cannot take risk on that. So there it is more about tax efficiency and making sure that money is not lethargic. Just do the basics, because some value add will happen. Right? It is not about great returns. It is more about inefficiencies are reduced.
Correct.
Right? So I think this is the two things that you have to keep in mind for a company or an entrepreneur versus an individual.
Okay, got it. Thank you so much, George. I think we all would have learned a lot about how we should go about our finances, especially in the short term, and how beautifully you can actually increase your baseline in terms of profitability just by doing some small things like a habit. And it's actually easy. You don't really have to sweat on it. You don't need a lot of education for it. Just go ahead and do it. Just make it a routine.